Everything you've been led to believe about pre-approvals is a barefaced lie. Let's talk about it. A pre-approval is not a mortgage approval, nor does it guarantee one. Think of it more like a rough draft of what a future approval might look like. Included in this rough draft is to give you an idea of likely future requirements, such as old divorce agreements, old tax returns, that type of thing. A pre-approval will also provide you with some valuable feedback, information on managing your finances, such as paying off credit cards or car loans, which may set you up for a bigger mortgage in the future. At the end of the day, what a pre-approval is it's an aid to understanding what you can afford. It's not a guarantee. I'm going to repeat that warning. A pre-approval is not a guarantee of financing. It is not a license to go out and make a subject-free offer. Among other shortcomings, a pre-approval assumes that the property is acceptable to the lender. Now, an acceptable property means much more than the value. It can also be the condition of the property or its legal status, even the form of ownership. All these things could quash a pre-approval with no warning. On top of that, all of the numbers that you have provided to the lender are subject to document review. There could be some little quirk in your old taxes that could end up sinking your pre-approval as well. If that weren't enough, statistics show us that up to 1 in 5 credit reports contains some kind of error in it, again, which could quash your pre-approval. The types of things that can kill a pre-approval include income sources from overtime, bonus or commissions, and self-employment. See, lenders generally want a 2-year average of these, but if the income figure is actually decreasing over the 2 years, they will take the second lower figure rather than the average. As far as properties go, condos can be particularly problematic, especially if there's been recent special assessments or deferred maintenance. It's important to understand that qualification rules can change at any time, and you may not be grandfathered in your pre-approval. Moreover, because there's no property involved, assumptions have to be made about property taxes, strata fees, and potential rental income. If any of these things are out of line with the assumptions, again, your pre-approval could mean nothing. When we do a pre-approval, we normally attach a 5-year fixed rate hold to it as well. This should be thought of as a worst case scenario rate, as the rate hold rate is a little bit higher than the live deal rate. The reason for this is that lenders have to set aside funds in case the mortgage does fund, but if it doesn't fund, there's a cost attached to it. Therefore, they build in a small margin to the rate hold rates. A lot of lenders have very expensive rate holds, or they don't even do them at all. Because of this, when a deal goes live, that is, you've got an accepted signed offer, the market suddenly becomes a lot more competitive as there's more players involved. Now, the rate hold rate, as I said, should be thought of as a worst case scenario over the 90 to 120 days that it's valid. If rates go up, you'll still get your rate hold, but if rates stay the same or go down, you'll probably get a better rate. It's also important to consider your credit report. Different lenders will use different credit reporting agencies, and some even have their own internal credit reporting. Because of this, because you got a pre-approval with one lender, you may not necessarily be eligible for the same level of credit with another lender. On top of all that, most lenders consider a credit report expired after 30 days. So in most circumstances, your pre-approval will have one credit report, but when it goes to a full approval, you'll be looking at a new credit report, and any changes will be reflected on it. A credit report is really just a snapshot in time. Major purchases, changes in your credit, such as a new line of credit or credit cards, can all change drastically what your credit looks like from the pre-approval to the approval. You also have to consider how aggressive the assumptions pertaining to property tax and such are. If a lender is trying really hard to win your business at the pre-approval stage, they might make very aggressive assumptions and approve you for a higher amount, but when it comes to the full approval, turn around and say that you won't qualify for it because the property taxes or the strata fees came in higher than what they had guesstimated. At the end of the day, any material changes in your credit could and very well might invalidate your pre-approval. A pre-approval is not a guarantee. What it does is it helps you to understand what you can afford so you can be more focused in your home search. It does hold a worst case scenario fixed rate for you in case of big interest rate increases. It It also helps you to set up your application for success, letting you know what you're going to need going forward. When you're working with a great broker, a good pre-approval helps you to understand that your finances are under control so you can focus your home search with your realtor. Regardless if this is your first time buying a place or your 20th, a pre-approval is the best place to start, even if it doesn't guarantee you will get the mortgage in the end.